This is Thoughts on Investing. Today we're breaking down what Hawkish and Dovish really mean, what the Federal Reserve actually does, and how it compares to other central banks around the world. If you've ever heard these terms and felt lost, this video will make it click. Let's start with the basics. The Federal Reserve, or the Fed, is the central bank of the United States. Think of the Fed as the thermostat of the economy. It doesn't control the weather, but it controls the temperature. If the economy is overheating, it cools it down. If the economy is freezing, it tries to warm it up. The main tool it uses is interest rates. The Fed has two main goals. First, to keep inflation under control. Second, to support employment and overall economic stability. Everything the Fed does is about balancing those two goals. That balance is where Hawkish and Dovish come in. A hawkish Fed is focused on inflation. When prices rise too fast, the Fed becomes hawkish. It raises interest rates. It makes borrowing more expensive. Think of it like pressing the brakes in a car. You don't stop instantly, but you slow things down. A real example of this was 2022. Inflation surged to levels not seen in decades. The Fed reacted by aggressively raising rates. Markets didn't like it. Stocks fell, especially growth and tech stocks. Not because companies suddenly became bad, but because money became expensive. A dovish Fed is focused on supporting growth and jobs. When the economy is weak, the Fed lowers rates. It makes borrowing cheaper. It encourages spending and investing. Think of it like easing off the brakes or gently pressing the gas. A good example is 2020 during the pandemic. The economy shut down almost overnight. The Fed cut rates close to zero. It injected liquidity into the system. Markets recovered faster than most people expected. Not because everything was fine, but because money became very cheap. Here's something important. Markets don't just react to what the Fed does. They react to what the Fed signals. That's why a single press conference can move markets. Even words like higher for longer, data dependent, progress on inflation can change investor behavior. It's like listening to a doctor's tone, not just the diagnosis. Now let's zoom out. The Fed is not the only central bank. Every major economy has one. The European Central Bank controls policy for the Eurozone. The Bank of England does the same for the UK. Japan has the Bank of Japan. They all use similar tools, but their situations are different. For example, Japan kept rates near zero for decades because inflation was very low. The ECB often moves slower because it manages many countries at once. The Bank of England reacts heavily to inflation and housing costs. Think of central banks like drivers on different roads. They all have steering wheels and brakes, but the terrain is not the same. This is why global markets can move differently at the same time. The Fed might be hawkish, while another central bank is more dovish. Capital flows where conditions are more attractive. That's also why currencies move when central banks change tone. One big mistake investors make is trying to trade every central bank decision. They jump in and out based on headlines. They react emotionally to short-term moves. But central bank cycles last years, not days. Long-term investors don't need to predict the next meeting. They need to understand the environment. Understanding hawkish and dovish policy helps you stay calm when markets move. So let's wrap this up. Hawkish means tightening to fight inflation. Dovish means easing to support growth. The Fed sets the temperature, not the weather. Other central banks do the same, but under different conditions. You don't need to trade these cycles. You just need to understand them. Because understanding replaces fear with clarity, and clarity leads to better decisions. If you found this video helpful, don't forget to like it and subscribe to the channel. It really helps support the content and lets me know you want to see more videos like this. And just a quick reminder, this video is for educational purposes only and is not financial advice. Investing involves risk, and markets can go down as well as up. Always do your own research and only invest money you can afford to leave invested for the long term.